I'd like to introduce you to Dennis Durand, Director of Loan Studio Wealth Management. Dennis, thank you very much for joining us. Dennis, can you tell me a little bit about your history and career to date?
Sure. Look, I've been in financial planning for 10 years. I originally started off working within the banking sector, etc. I got a bit of TV and radio exposure. From that, I decided to set up my own business, which was probably about 5 years ago now. And since then, I've been self-employed ever since that date, independently, licensed as well as a financial planner. And we run a financial planning business with 3 advisors and a staff of administration.
Fantastic. So what is the role of a financial planner?
Yeah, interesting question. It's quite simple. If you think about, every individual has goals, and every individual has financial goals. Apart from health goals and lifestyle goals, etc., we're here to take care of their financial goals.
Fantastic. In a nutshell, I suppose there are a lot of average financial planners out there in the marketplace and in the space that we operate in. What do you think are the key areas of difference between an average financial planner and a very successful financial planner?
Again, simply empathy. I think you need to care for the client. You need to care about what you do. I think things like empathy, integrity, a history of looking after clients and servicing clients. And one other thing that I've noticed in the industry is just independence. I think far too many financial planners today are licensed through a big bank or a big insurer, and you question the sort of independent advice you're getting from them because, again, when you're working for a big bank, you have to move bank products. And I think to find an independent advisor would be one of the first things I would look for.
Fantastic advice. And what do you feel makes a good investment strategy?
Yeah, interesting question. Again, it depends on the person. So many of our clients can be 25 years old, and some of our clients are 70 years old. So a good investment strategy is a strategy that helps you to achieve your goals where you're sleeping well at night. Because if you're not sleeping well at night, then you're going to be uncomfortable with the strategy that you've got, whether it's achieving your goals or not. Often also we look at taxation, in what sort of taxation system your investments are set up, and that obviously means superannuation. Okay, it's the most tax effective vehicle the country has. So from that, just simply I think it's an investment that achieves your goals, that helps you to sleep well at night as well.
You talked about superannuation, and we'll talk a little bit more about that in a minute. But can you maybe discuss a few of the different areas in which you would advise your clients to invest in? Sure.
So a lot of what we do for clients, again, because of our relative independence, is we look at whatever helps them to achieve their goal. So if that means term deposits, then it's term deposits. If that means bonds or managed funds or direct shares, some people want to own Commonwealth Bank shares. Some people want to own Telstra shares as their retirement investment. We're here to satisfy the client in terms of what they're after and to achieve a return at the lowest risk possible.
Fantastic. And back to superannuation, SMSF, can you tell us a little bit about what it actually is and how it works?
Yeah, look, a self-managed super fund is simply a vehicle which allows individuals to control and run their own self-managed super fund, their superannuation, and they'll act as trustees on their superannuation, and they'll control and run it themselves instead of having a big institution run it for you.
And I suppose within the self-managed super fund, or SMSF, they can once again focus on various different types of investment products.
That's right. Yes. The advantage for them is really control. So because they're their own trustees, they're responsible for their own superannuation. So control is theirs. Where they invest that money is completely up to them.
And why should someone consider an SMSF, and at what stage? And a comparison of costs, I suppose, is the next step to considering whether or not it's worthwhile.
Or not? Yeah, that's a good question, because often I dissuade a lot of people from self-managed super fund A lot of people are convinced to go into a self-managed super fund by their accountant or by their friend, and they don't really know why they're going into it. In my opinion, the most important time that I when I'm talking to a client, and the important goals to look at is control. If they say, Dennis, I don't want shares, it's too scary. I don't want international shares, I'm scared of that as well. I only like property. That's what I like, bricks and mortar. Then at that point in time, I tell them you need to set up a self-managed super fund.
Right. So it's well suited to purchase property within an SMSF. What are some of the other benefits or considerations that a client should look at?
Yeah, without a doubt, cost. Since the GFC, cost has become very important. Everybody's talking about fees. And fees are dropping rapidly. But depending on the amount of money you have to invest, there's no cheaper form of investing for retirement than through a self-managed super fund. So to give you a quick example, if you've got $1 million in your self-managed super fund, okay, and you are sitting into an industry fund of some sort, you'll pay probably $10,000 in fees per annum, and they'll run that super fund for you. You don't have a choice. You'll choose within their guidelines. If you ran a self-managed super fund with $1 million in there, it would probably cost you $2,500 a year to manage. So again, that's 25% of the fees the industry funds are charging. So cost is probably one of the key factors in influencing a client to use a self-managed super fund.
And is it difficult to set up? What are the processes involved?
Yeah, look, you'd need to talk to your accountant to set up a self-managed super fund, or talk to your financial planner to set one up. It can be a quick process. It can take a few weeks to set up. What takes a long period of time is actually moving your superannuation and your spouse's superannuation. Moving that money across to your self-managed super fund becomes the most time-consuming part. That can take a month or even longer sometimes, and hopefully if you've got a financial planner working on it, then it might be quicker than that. But to set one up, it should take a couple of weeks. It's fairly easy, and your financial advisor or accountant can do that pretty easy for you.
So obviously you need to have a good financial advisor, financial planner. Do you see more and more people moving into SMSF in the near future?
Yeah. I mean, I can tell you it's the fastest growing part of our industry. It's outgrowing all the growth coming from superannuation at the moment. Self-managed super fund represents the fastest growing sector. So I think it's going to keep going. I think it's going to get bigger and bigger.
So if property purchase was the key area in which was driving a client of yours to move into a self-managed super fund, how little would they need to actually have? I mean, could they do it with $150,000, for example?
Nearly. It depends on what they want to buy. So if they're talking about buying $1 million property, then absolutely no, they can't do it with $150,000. They really need to think about having a 30% deposit when they're looking at they could be buying an apartment for $400,000 or a house for $700,000 or something bigger. They really need to say, well, do we have a 30% deposit there available? And that includes their money, okay, so their money and their partner's money combined. So generally speaking, around about $200,000, will get you close to a $500,000 to $600,000 property. So I think that's probably a good start.
And I suppose that's where the connection with a mortgage broker would come into the equation to factor those calculations out.
Absolutely. Your mortgage broker often is your first port of call. And the role of the mortgage broker in the whole process of dealing with a client is they often become the project manager. So they'll project manage the client to speak to the financial advisor, speak to the accountant. So the mortgage broker becomes fairly pivotal.
And what's the specific role of the financial planner within the SMSF space?
Okay. Obviously to guide the client as to, is this the right thing for them? so they understand the loan and the obligations that they're entering into. There's a lot of trustee administration. There's a lot of compliance involved, and I think many clients may not understand fully what it is to set up a self-managed super fund and what's involved. And I think that's the first part that the financial planner must attend to, just to let them know exactly what their responsibilities are.
Excellent answer. So for a mortgage broker, what are the key benefits in partnering with a financial planner?
Okay, that relationship's very important when setting up a self-managed super fund and dealing with a financial planner and a mortgage broker together. Cuts out a lot of the time the client has to follow up paperwork, talk to their bank, talk to their financial planner. When the two are working together, that saves the client an enormous amount of time, but it also represents a one-stop shop for the client as well. So I think from a time perspective, it's the best way to go, and the mortgage broker and the financial planner can work together themselves to achieve the best result for the client.
And in your opinion, how do you see the Australian share market operating in the next 12 months? I mean, obviously you don't have a crystal ball. We understand that.
My crystal ball's been foggy in the last few years, I can tell you, since the GFC. But look, it's the market where it is at the moment. It's quite interesting because interest rates are low, and without a doubt, when you have big companies that are paying dividends, including your franking credit, and they're paying dividends of 7 to 8%. Big blue chip boring companies are paying 7 to 8% in dividends, including your franking credit. Then mums and dads are saying, well, geez, money's interest rates are 3%. I'm earning 3.5% for my term deposit. It's forcing mum and dads into these sort of shares. So long as interest rates stay low, and I believe rates will stay low at least for the next 12 months, I think you're going to see the share market driven higher. Now, that also depends on the currency. So there's a lot of other variables that will come into play over the next year. I think our currency will come back a bit versus the US. So there are quite a few variables coming into play. But notwithstanding, I think the Australian share market will be about 6,000 points. We're about 5.5 now. We'll be about 6,000 in about 12 months' time, so long as rates stay as they are. And still, that's well below where the pre-GFC high as well. So it's not like we're getting to, nosebleed highs on the share market.
Okay, so you touched on interest rates being low. Based upon that, would you say that a property is a growing segment of investment, and would you suggest that it is an important part of an investment strategy?
Yeah. Well, look, we tell people to diversify all the time. Diversification means reducing your risk, and to diversify against property, you take shares, and vice versa. So I think a mix of both is great. Whether you hold that property inside of superannuation or outside, doesn't really matter. The shares inside or outside, again, it doesn't really matter. So without a doubt, property, where you're buying is obviously important. There are markets like Brisbane that I think will do well over the next 5 years. But property, again, as a diversification strategy against shares, works extremely well.
Very good. And I suppose in closing, there are plenty of people out there that haven't engaged a financial planner. What would you suggest would be, and if they're sitting on the fence and thinking about whether or not they should speak to a financial planner, or certainly come through to you at Loan Studio Wealth Management, what would be the 3 main points that you would suggest they consider?
Again, find an independent financial planner. Everyone's got different personalities. You may not get along well with a financial planner that you find or that you choose, but find an independent financial planner first. I think that would be the first criteria. Make sure you before you go into the meeting, that you make sure you don't get charged a lot of money for the meeting. For example, we don't charge anything for any consultation with the client. So make sure you're not getting clock turned when you walk into a meeting and you're paying $200 an hour for the meeting. So make sure that's not on the table. And again, seek 1 or 2 opinions. If you're talking to a financial planner and you're not exactly comfortable, again, try and find another financial planner and look at different opinions and look at who you're most comfortable with.
So certainly the advice would be, if you are sitting on the fence and you're not sure whether or not you should engage a financial planner, look up Loan Studio Wealth Management. Dennis Durand, thank you very much for your time.
Absolutely.